Welcome to Eye on Mortgage, where we keep you updated on what's happening in the mortgage industry and what you need to know about the mortgage process. Are you a first time home buyer? Looking to refinance? Interested in a private mortgage? Perhaps you want to know more about purchasing a new build or the reverse mortgage product. Whatever your interest, stay tuned to Eye on Mortgage. Oh, and please take a moment to like, share, and subscribe. All right. Okay. So we have Guy from Homeowners Soon. Okay. And I do have a lot of clients that actually do have questions about the rent to own product, Guy.
Sure.
It's a great opportunity, of course, for us to, give them some information so they understand what it's all about. There's a lot of misconception about the rent to own program. And I want to put some of that to rest to start off this interview, of course.
Sounds good.
Right. So, before we do that, if you can tell us a little bit about yourself, how long have you been in the rent to own business with this particular company?
Well, I joined Homeowner Soon back in 2005. Actually, I was enlisted as a credit manager because the company existed with two partners, Alex Kluge and Mark Loeffler. So when they came on board, they actually started the rent to own. And rent to own itself is a concept that they brought in from the US because in US, rent to own is very popular. So first time I saw this actual program, I saw, basically some issues. Being a mortgage agent with my background, I quickly identified what that is. And I started to, put some of the underwriting guidelines that we have in the mortgage industry into the rent to own. And, we've been doing this for probably around 17 years now. And we're probably the longest, oldest standing rent to own company in Ontario. And we were the first company to be granted the diamond status for the Canadian Association of Rent to Own Professionals. So that's a huge milestone for us because now we've transacted over 1,000 properties and still climbing, and we're actually still growing.
Okay.
So there's an ongoing need because right now, we'll always find the cheaper the rate, the harder to get. And that's a good thing to say. Just such
Yeah.
are so low right now. If we notice the even the qualifying rate now has risen to 5.25. So
Right.
the government's looking ways to slow down the market. And because of the multiple offers, everything is just going, 10 to 20% over asking. So we're identifying a lot of consumers, which is caught. Okay. They either, they have some bruised credit, they don't have enough down payment, and they can't get into the market itself.
Right.
And they're realizing that the chance of home ownership is starting to escape because if houses are rising at a rate of $10,000 per month, by the time you save enough money for a down payment, guess what? That house is up another 100K and you're basically still saving. So 3 years later, you're still renting. So the rent to own product is an excellent route to actually put the client into a house immediately based on their income,
Right.
based on all the guidelines that CMHC or a mortgage lender will require. The only difference is maybe possibly their down payment is not enough, or they just need to correct some of the credit issues.
Yeah.
So that's the reason why our success rate is greater than 95% at this point.
Now, with one of well, first of all, when I used to hear about the rent to own product, I will say that wasn't very good stories, right? And I'm sure you're quite familiar with that. How do you put that to rest? I mean, you've heard stories where people, at the end of the term, all of a sudden they're not getting the house anymore. How do you put that to rest with someone who heard these type of stories and somewhat interested in the rent to own, but hey, I've heard someone who's been in rent to own and it wasn't a good experience.
Well, absolutely. We get those stories all the time. Even when we started the rent to own process, we had a huge amount of defaults, okay, in the very beginning. And that's when people get disgruntled and they go on Google and say, rent to own is fraud and everything else.
Mhm.
So we try to bury some of these things because, again, a lot of times the rent to own companies out there, they're not finance people. These are guys or investors who basically took some $5,000 course from, Robert Allen Institute in the States, and they got a little diploma for that 5,000 US dollars. And next minute they're a rental professional, which is not always the case. And the reason why a lot of it failed is because they were using some of the guidelines that they use in the States,
Mhm.
it's different in Canada. Mortgage qualification is very much different than US. US, basically, if you have a pulse, they'll just sign you up and give you a mortgage. Here, I mean, they're looking at debt
Yeah.
ratios, they're looking at credit, they're looking at serviceability, they're looking at the house.
Mhm.
They're looking at a lot of things before they even say yes. So
Okay.
that's the reason why a lot of the files that originate from other rental companies do fail. Number
Mhm.
one, the contracts. We've gone through probably over a dozen versions of contracts, and our contracts now have been field tested with CMHC, Genworth, and Canada Guarantee.
Okay,
So,
good.
even now we have cooperations with major banks that are
Mhm.
actually doing some of the exit mortgages, okay, for these rent to own.
Okay.
And that's the biggest thing right there, because a lot of times we even have brokers who send in a file that says, I've got a rent to own client. It's not yours, it's from somebody else. And when they
Yes.
see the contracts, right away, there's like red flags everywhere. I mean, that's the reason why
Mhm.
they've been to several banks like TD, RBC, and they just decline them flat out. And we
Right.
see these areas where there are red flags. No, this clause has to be rewritten. This is not incorrect. Maybe the underwriting guidelines were not even entertained in the very beginning.
Mhm.
I saw a file where they're exiting on a $700,000 house, and their combined income is around 70K. I mean,
Ooh.
just TDS ratios don't work, and
No,
they're
no.
wondering, how can I get out?
Yes.
So
Yeah.
we're experiencing a lot of these horror stories and rent to own. That's the reason why it's very important to investigate a company,
Yes.
see what their track record is, how long have they been in business, and
Mhm.
how many transactions have they done.
Right.
Majority of rent to own companies, they do probably maybe 2 or 3 deals a year. That's it,
Mhm. That's it.
3 deals
That's it.
a year.
Yeah.
And they're not full time. I mean, they got a full time job, and they're just doing this on the side just
On
to
the
make some
side.
extra money investing. And that's where the
The
issues come.
problems. That's where the problems
Oh,
are.
absolutely.
Yeah. So with now I've put a client of course through your company, and the experience, I had a great experience. One of the things that I love that you speak about is that exit. You guys are very concerned about the end being a win-win. Um,
Absolutely.
right. You want to make sure that they do get in, that the name is transferred from the investor into their.
Mhm.
Kind of get to that, who would be the best candidate? I mean, what files are coming across your desk right now in terms of the best candidates for this program?
Well, basically, anybody that's not reporting their income, I'll give you an example. We get probably 50% of our files are business for sale people.
Mhm.
They could be a truck driver that owns their own tractor, and they could be booking in $175,000 a year. And because of expenses, write-offs, the accountant have taken their income down to 70. And they're looking to buy a $500,000 house, and their income doesn't qualify.
Right.
We've got instances where we've got a lot of contractors where they say 40% of their income is coming in as cash because they're doing a basement renovation for $65,000. They don't want, the client doesn't want to pay HST, they pay them cash. So it goes on unreported. So we see a lot of these things that happen. I've got a deal now in Windsor where she's a teacher who
Yeah.
teaches a art program.
Mhm.
Her income, I looked at last year, she brought in 11 grand.
Oh.
Well, in
Yeah.
actual fact, she actually does around 65,000, but she doesn't report it because
Okay.
they just bill it out. It comes in as cash. They don't report it. And these are issues a lot of people do. I mean, because nobody likes to pay taxes.
Mhm.
But, as they're doing it, the actual business, they realize, it'd be nice to own a house instead of
Yes.
renting.
Yeah. Yeah.
So, especially when they're seeing houses rising such an enormous rate, and they're going to say, oh my goodness, if I get qualified for a mortgage, it's going to take me 2 or 3 more years. A house is going to double in value. We're
Mhm.
not going to be able to afford it. So they
Right.
really want to get in now. So
Right.
we got
Yes.
an opportunity. These are a lot of people that are coming
Okay.
into our program.
Into the
Also,
program.
too, you have people that are coming in with slight bruising on her credits.
Mhm.
So in other words, you've got a 610 beacon score, you have a couple of trade lines, but to show a couple of collections,
Mhm.
and it's just not strong enough for a CMHC to say yes with a 5% down program.
Right. Yes.
Those are ideal candidates for us because we could put them in a 3-year program, very short, come up with basically how we do it. We always try to increase the down payment. Okay,
Mhm.
so that's something that we do better than all rental companies in Canada
Okay.
combined.
Yeah, that actually brings me to my next question, actually. Now, the monthly payment obviously is not a traditional monthly payment. Can you walk us through what is a part of that monthly payment? Like, if you know, give us maybe a estimation as to this is the property value, or the mortgage, and you know, or this is the purchase value, this is what your mortgage is going to be, and break down that monthly. What's all involved in that monthly mortgage payment?
There's a lot of variables. Okay, so when we do calculate a cost, we generally do a custom solution for every client. So not every 2 clients are ever alike,
Okay.
because their needs are different. Okay, so we look at a client and we try to estimate exactly what is the underwriter on the back end looking for when they come out. Are they looking for a high ratio, or it has to be a conventional?
Mhm.
So those are very important. So the main component in our program is to build the down payment during the program. So think of it like a layaway program for a house.
Okay.
You're just putting money aside every month until you have enough. Boom, that's when you buy it. And that's the best way to describe it. So we would generally credit, let's say if a client is paying $1,000 a month,
Mhm.
anywhere from 200 up to $400 of that money will be credited back. Now you're
Mhm.
going to ask, okay, so why is some guys doing 20% credit back, some guys 40% credit back? Again, it comes right back to that custom solution. What are we looking to achieve? What is the exit strategy? How can we get these guys to succeed at the end? I always say the success in our program is not approving a client into a rent to own.
Mhm.
Success of the program is getting them out.
Out. Yeah.
Yeah, so we're in there for a long haul. Even recently, we started a new program, Path to Home Ownership. So we're finding that, you know, a lot of times clients who get into a rent to own program, they're still not accustomed to owning a house and getting
Mhm.
ready. So we make sure that we have customer service people that actually call the client, work with them in terms of monthly budget, how to save, what to do to rebuild their credit, get them in a safe place. So in the future, when we actually walk them into a CIBC or a BMO, they're going to look at a file that says, hell yeah, we're going to fund
Yeah.
this deal. Okay, you're approved. Okay, so,
That's what
and
we want
that's
to hear.
exactly
Yeah.
what we want to see.
Okay. So what do you guys put in place to prevent, you know, we know that, you know, nothing is 100%, right? But you do put things in place
Right.
that will create that win-win at the end. Now, if you have a client, let's say, that has a whole lot of debt, what do you put in place in this program to make sure that when it's time now for that mortgage to now transfer from the investor into their name, what do you put in place to make sure that it is successful, to avoid disappointment?
Okay, now that doesn't scare us. It all
Okay.
comes down to income. What
Okay.
scares us is collections and writs and judgments. Those are
Mm,
the things that stays on your credit bureau for a
7 years.
period of 6 years.
Yeah.
That's the reason why a lot of applicants that come into our program, they might have filed for consumer proposal, they might
Yeah.
be bankrupt. So we see various different type of clients in there.
Hmm.
So it's extremely important to make sure that the debt ratios work. And we really stick to the debt ratios because a lot of times we see applications come in, they're making $50,000, $60,000 a year, and they're looking at a $800,000 house in, let's say, Oshawa. Well,
Hmm.
$800,000 house looks great, but guess what? Your payments are going to be astronomical to the point where you can't afford it.
Yes.
And if you combine that, let's say you have a couple of car payments, you have credit card payments, that TDS could be somewhere up to 80%, and automatically we will decline that file. Okay,
Hmm.
so we tend to look at it. So, you know, that doesn't scare us. Now, we do have situations where, let's say they're buying a house in, let's say, London, Ontario, and they're paying maybe $400,000 for a house. At
Hmm.
the same time, husband has a good income, $150,000 a year. The wife's an office manager making 65. I mean, they have a combined income of $215,000. I mean, technically they could afford 800,000, but they chose a $400,000 house because they are saddled with probably maybe around $80,000, $90,000 worth of debts. So
Oh,
when we actually put the monthly consumer debt, add in the payments, calculate the total debt service ratios, it's still within guidelines. So we're still good.
it's
And
so
also to look at the debts, the terms too.
good. Hmm.
Let's say, for instance, they have a car loan that's gonna, let's say, mature within 2.5 years.
Hmm.
So we don't have to consider that debt loan on the exit because that's
Right.
going to be paid off,
Paid off,
and then
yes.
their debt is going to drop.
Okay, all
So
right.
these are very important things.
Yeah, for sure. And I mean, what in the case, let's say, like, God forbid, there's a case where at the end of the term, that financial situation is not looking as it should. What happens then? Are we finding a new investor? Is there a risk of losing the home? What's the plan? I'm sure you might have come across situations like that.
That's a great question. If we did our job, we shouldn't have to worry about it.
Mhm.
But I always say the big D words:
Yeah.
death, divorce, and debt.
Yes.
Okay, those are the big
Yeah.
killers. Okay,
Yes.
all
Yeah.
right, and we've had situations where we have a 5-year term, and 3 years in, we have a marriage breakup. We've seen
Mm,
that happen.
yeah.
I had clients in the first month fell off a ladder because they had a brain aneurysm and went into a coma.
Oh boy. Wow.
And yeah, it's weird. I mean, circumstances
Yeah.
arise. That's why we say we have generally about a 95% success rate because we can't forecast the inevitable. Okay, so
Yes.
something happens to your life, it happens. Okay,
Mhm.
so we try to make the best out of it. So we try to make the contracts as flexible as possible. And if you notice, all our rental contracts are fully open.
Mhm.
Okay, so I'll give you, for example, let's just say we are doing a deal right now for 3 years. 2 years in, just say the husband got laid off, and that
Okay.
happened due to COVID.
Mhm.
They've been off work for 7 months. They haven't been making payments. Our investor's been really lenient, and they were looking for an exit strategy.
Mhm.
So at the end, instead of just taking a house away from the tenant buyers, we generally engage with social responsible investors. These investors are the ones who are financing you. Think of it
Mhm.
as like you're joint venturing with your rich uncle. He's
Yeah.
gonna he's gonna basically buy you the house. You're gonna make the payments to the uncle, and everything's all hunky dory. And at the end, uncle wants off the title. Okay,
Yes.
and that's the way to describe it. But
Mhm.
situations do happen. So when they do fall behind, we have a couple of cases now where they're in trouble because of income. So
Mhm.
um, some people bounce back and some people don't. So that's the reason why we keep the contract open where, we could actually sell the property. And because properties have gone up anywhere between 20 to 30% a year, let's say the exit price on that house would have been 560,
Yeah.
but the house now is worth 675.
Mhm.
So there's a bit of sweat equity built up by the tenant buyer. So we could actually sell the house.
Mhm.
The investor gets back basically their return, get back their principal, they get everything back. And
Mhm.
the tenant buyers could also enjoy some of the appreciation. I'm just
Oh,
doing one right now in
yeah.
Brampton where the client came with 3% down.
Mhm.
And they're saying we're gonna save money on the side. We're gonna be excellent credit, and everything's gonna be great. And guess what? They were laid off. They went
Yeah.
and bought a car.
Oh boy. Not good.
Yeah.
Yeah.
So we're going, oh
Oh
my
boy.
goodness. But the
Yes.
good thing is the house has gone up an extra $100,000
Right. Right.
against the exit price. So what we're going to do now is we're going to close with a private lender
Mhm. Mhm.
and do an open mortgage, and then they're going to liquidate. And once they
Okay.
liquidate, the proceeds, guess what? Now it's enough to get them into a mortgage. So they're going
Mhm.
to go from a basically a 2-unit semi-detached house in Brampton, and then now they could afford basically a condo.
Okay, okay.
with a mortgage.
All
So,
right.
we're always trying to find a solution to the
Solution, and I like
yeah,
that, a
yeah.
solution, yeah. Now, you mentioned 3% down. Now, I mean, what is the, I'm always thinking, 5%. So you guys go as low as 3%. And if you can explain too, at the end of the term, based on what's coming out of that monthly mortgage payment, you'll end up with 10% down or potentially more depending on how it's structured. Could you explain that?
Well, absolutely. Now, we were toying around with 3% down.
Yeah.
That sample that I just quoted was a bad case example. Okay.
Okay.
We
Yeah.
should never have done the 3%, but at a time when it came in, that's all they
Yeah.
had.
Yeah.
Lack of budget judgment, we approved
Love
it.
the honesty. Love the honesty.
Because that's all they had, instead of turning it away, we
Yeah.
try to help them. So it kind of worked out well. But generally, the 3% down is basically targeting to clients that are really well, great beacon score, great job. And the only reason why they got turned down is not because of credit. It's
Mhm.
because maybe they've only been on a job for 4 months. Or
Oh,
maybe
okay.
the TD Visa card that they only got it in January of this year. So they're considered credit light.
Yes.
So
Yes.
we don't mind going with 3% down because they're already 700 beacon score. They already got a great paying job. The only
Okay.
thing we need is more history. Okay.
Yes.
So
Yeah.
we will do a 3-year deal on that. They will stay on a job. At least they'll have 3.5 years experience. They'll have
Mhm.
3 years of experience on their credit card. They would build another credit card. So that's why we would go with 3% and exit with maybe a 5 or 6. Okay. So they'll have enough for 5% plus
Mhm.
closing costs.
Okay.
So those are extreme cases, but generally I would say probably greater than 95% of our people come in with a minimum of 5%.
5% down.
I've seen
Okay.
people come with 10, even
Mhm.
15%.
Okay.
So
Okay.
you're kind of wondering, well, why are they getting 15%? Why can't they get a mortgage? Well, B lenders require a minimum of 20 to 25% down. So they
Right.
still don't
Yes.
have enough.
Yes. Yeah.
So, you don't want to put them in a private, yes, I got private lenders that will lend up to 90%, even 95, but those are
Mhm.
1-year term.
Yes.
And
Exactly.
these clients do not need a 1 year. They need 2 or 3 years,
Position
maybe
themselves.
4 or
Yes.
5.
Yeah.
So why put them in trouble in the first place? So
Mhm.
again, everything's a custom solution. We look at the customer's situation and we
Mhm.
try to gear towards that with using the mortgage brain. When we look at it and say, all right, how do we get these clients a mortgage? And basically what we're using is the rent to own as a vehicle to help
Yeah.
them get to that point. So
Right.
try not to think of us like a rent to own company. Try to
Mhm.
think of us as a finance company using creative solutions to make sure the client achieves their goal.
Okay, good. Now, can you take us to the investor side, right?
Yeah.
So that, for those who are listening and have interest in this product to understand what part does the investor play, in the whole process, how they compensated, so they can wrap their head around that and understand, why, especially with, the costs and all that, everything could kind of come together and make sense where the investor side is concerned. How involved are they and what part do they play?
They're involved in a very initial beginning, okay? Because again, it's the investor is the person who's purchasing the house. They're
Mhm.
taking a lot of risks because if there's any defaults, at the end of the day, the investor has to make that mortgage payment because our investors, they're all AAA credit,
Mhm.
AAA jobs.
Mhm.
And the banks put so much scrutiny to these investors that they got to be able to walk on water before they can
Right,
get a mortgage. Okay,
right.
so we vet them out. I mean, the banks vet them out, everybody vets them out, and they're really solid people. And
Mhm.
the most important part is they want to help somebody. If not, they will
Yes,
just lend the money out in second mortgages or put it in GameStop or buy
right.
Bitcoin, whatever.
Yes,
I mean, they
yeah.
don't have to buy real estate. There's other
Mhm.
vehicles they could invest into.
That's
But
true.
they do because, again, they're helping fellow Canadians to get into a house. So it gives them that warm and fuzzy feeling. At the same time, the investor does want to protect their interest too. So if we're doing a deal, let's say in Quaffer Lakes, it's a cottage style property on rural land, well and septic, and the roof is caving in because there's
Mm.
water damage. Does the investor want that house? No.
No,
Okay.
no.
Because Do they want that old piece of house that's on Ritson Road in Oshawa where it used to be a rooming house and place stinks, there's roach problems, mice problems? Do they want that? Sometimes, sometimes not. Okay, it all depends. I mean, if the tenant buyers are coming in, they are construction people, renovators, they don't mind clients coming in and renovating, gutting the house, as long as there's no structural changes. If they're just changing floorings, walls, kitchen, baths, that type of stuff, that's all great because that's all beautifying the house and everything else. But they do get involved. Now, where they do get involved is every deal that we do requires a home inspection. Okay,
Right.
so last thing you want to find out that home inspection, there's a crack in the foundation and the sump pump doesn't work and they detect moisture. So the investor may say, well, I don't know, we want to do this house because not because we want to be, hard on you, because we want to spare you the pain that, you know, in springtime, you're not going to have a river running through your rec room, or suddenly your furnace just goes out in the middle of winter and it's minus 30 degrees outside because the furnace is 35 years old,
Yes.
or you've got a roof that's it's on the last leg of life, and the first rain that comes in, guess what? You got dribbles coming down your living room.
Yes.
Okay, so they try to get involved in that type of stuff because they do have experience with real estate, and a lot of times it's almost like having your experienced rich uncle who buys real estate as your investor. He's going to say, "Hey, buddy, don't buy this house. It's nothing but trouble."
Yes.
So they get involved. Other than that, they're basically hands off. Okay. You don't really hear about them. They may call you up once in a blue moon, say, "Hey, this is Bill. I'm your investor. Remember me?
Yeah.
How are you doing? How are things? Is house doing well?" They may check up on that, okay, to make sure that you're totally happy.
Right.
And that's
Right.
great. I've had one investor that bought a whole bunch of houses in Nova Scotia and New Brunswick. So every Christmas, she drives out there just to say hi to them. And they cook her Christmas dinner. Yeah, it's great. So sometimes you got a lot of bonding that happens between the investor and the tenant buyers. I mean, they become friends a
Yeah.
lot of times.
Yeah, and I do like that. I mean, of course, once again, we go back to the point that you made that they are helping those get into the market, right?
Yes.
Helping clients to purchase their homes. And I do think it's a great product. You just have to align yourself, of course, with the right company. So Homeowners Soon, once again, this is, the company that I work with. As I said, I've heard horror stories, and when I connected with Homeowners Soon, it was a great experience. And one of the things that I loved about them is them continuously pining on the exit plan. It wasn't, okay, let's get it done. Let's get it done. We could do it. No, it was, let's really take a look at this and see what's the exit plan going to be. Are we able to get this client out? Because they want it to be a win-win. So it's a great product. It's not for everyone. You just like the private lenders, it serves its purpose, and it helps people get into homes. So, I want to thank you so much for taking the time, Guy, for, of course, answering these questions. I'm sure there might be more questions that are out there. I want to invite you to definitely, email me, place your comments even on this feed, and I'll certainly, get those questions answered for you, because once again, we're here to help. We're here to help to position you to get into your home. There's many different strategies, and of course, this is one of them. And we want you to be able to understand exactly how it works, so that it kind of, erases some of the fears, some of the negative, stigmas that are out there with regards to this particular product. So once again, thank you so much, Guy, for taking the time. All right. So once again, this is Ion Mortgage.
Here.
Bringing you information, about different products in the mortgage industry, or what's happening in mortgage land. All right, thank you, and stay tuned until the next one.
All right, thank you. Bye-bye.